Let's get a read on how the economy is doing now. You mentioned a special guest, and indeed, we do have one. Tom Barkin, president of the Richmond Fed. We're here at the Richmond Fed with him, and I know you haven't had a chance to really look at these numbers, but in general, the low-hire economy and the tariff-affected economy seem to be about what they have been.
Well, it's always good to come on right after a bunch of data comes out, but I wouldn't be as negative on the productivity as you just were. 2.8% on a last 10 or 20 or 30-year basis is a really good number, and I think we are seeing companies invest in productivity and deliver it. Some of that technology, AI, but I think a lot of it is you were caught short workers 3 years ago. You invested in new processes, new staffing models, automation, and people are seeing the results today.
And that holds down inflation.
It does hold down inflation, and it allows people to maintain margins at times when their input costs might be coming up.
Well, input costs are probably going up for people who use petroleum. So I want to start there with, obviously, the Iran war just started. But what's your gut feel about how that's going to impact prices and the economy?
Don't have any sense on how long it's going to take or what the implications are going to be. Obviously, you watch oil prices. While the U.S. is no longer a net importer, it's still the case that the price at the pump matters a lot in terms of sentiment, in terms of crowding out other spending. And so I'm just watching prices at the pump. They've jumped up over the last week. You can see that when you drive around. But of course, no one knows whether this is going to be short-term or long-term, and so we'll just see where it goes.
Well, back in the 1970s, we had the oil price shock, and we had gas lines, and people were miserable and having to pay all this money, and so the Fed eased into that. That turned out to be a mistake. Does this put on hold ideas for the time being of continuing to cut rates?
Well, I think we'll go meeting by meeting, and we'll see what we see when we get there. Gas prices, obviously, if they're up, that is inflationary. Textbook monetary policy would be you look through a short-term shock, but you don't look through a long-term shock. And I think that's a lot of the assessment people are going to have to make.
Well, the Open Market Committee, before the Iran war started, basically the views seem to be that we're at peak tariffs now, and inflation will start to come down in the latter half of the year. But you throw this into the equation, where would you put yourself in terms of thinking about the progression of inflation and when you might have enough information to decide whether a cut is worthwhile or not?
Well, we'll have to see how it evolves. If you go back to the fall, the conversations I have with businesses suggest to me that they believe their pricing power is very limited. Consumers are exhausted by inflation, affordability. People are pushing back, whether that be not purchasing or private label or trading down to lower price retailers or repairing rather than replacing. And so in the conversations you do have a sense that we're on the backside of this inflationary period and we'll head back to normal. And the numbers in the fall, absent the government shutdown, we're saying much the same thing. I will say over the last month and with the PCE numbers that we're expecting next week, you've got a couple months of relatively high inflation. That certainly puts pause to any conclusion that we're done fighting this. But we'll see where we go.
Well, slicing what the business leaders are telling you a little more closely, they know consumers are price sensitive and they're worried about that, but are they also in a situation where they've had to absorb too much? And if we see more price increases of inputs, they're going to have to raise prices.
Well, that's where we come back to productivity as being so key to this whole story, because most every business I talked to last April that got tariffs was going to pass it on. It was just clear, and they needed to maintain margins. The consumer was going to have to take it. And when they experimented with that, they got a lot of pushback. And so prices didn't increase the way that a lot of those folks expected. Now, their margins have been very steady. And so corporate margins are quite healthy. Earnings were up, I think, 13% fourth quarter year over year. And that's because productivity has allowed people to absorb these hits without having affect margins and having to pass it on fully in prices. And when you start seeing good productivity numbers over and over and over again, that gives you some hope that can continue.
What are you hearing from businesses about the other side of your mandate, employment? Obviously, we're seeing low fire continue.
Yeah, I have to say, the businesses I talk to, when they describe the labor market, they describe it as pretty open, maybe even loose. Availability is high, turnover is low. I was with a bunch of poultry processors in the Eastern Shore who told me that even after losing workers, to temporary protected status, they've been able to replace them relatively easily. And if you can replace poultry workers, I think you've got a reasonably open job market. And of course, going back to the fall, that's what we saw as unemployment was ticking up. I will say the last couple months of employment data has been, reassuring. As you've seen, the unemployment rate came down, jobless claims have stayed low, and so you still hear a relatively loose labor market. You still hear people not hiring but not firing, and but the numbers are even better than I think what you hear.
Well, it sounds like you think at this point the risks to inflation and to employment are roughly balanced.
Yeah, if you go back to the fall, I think a lot was behind our moves was the sense that the risks to the labor market were up while the risks to inflation were down. The data that's come in over the last couple months would, I think, suggest it's moved in the other direction.
Well, you mentioned that you're going to get probably an elevated PCE reading coming up. At this point, is monetary policy set at a place where it can help you bring down inflation, or is it even too tight? Where is it on the scale?
Well, I expect we're still, modestly restrictive, and that should help as we try to grind out the last mile here. But again, we'll have to see. I definitely take note of the continued strength in demand, and so I don't think we're highly restrictive. If you were highly restrictive, you'd see a lot more impact on demand, which has stayed, very healthy. I was reflecting. It was 4 years ago that we first started increasing interest rates in March of 22. And if you had predicted then that we would have demand growth of the sort we've had over the last 4 years, you would have been a severe outlier.
Let's talk about your new boss who's coming in theory. I guess Kevin Warsh's nomination's finally gone up to Capitol Hill. A lot of people think the Fed chair can walk in and just change interest rates, but they don't. You all have a vote, and his basic power is in persuasion. How do you think he'll do? How do you think the dynamics play out when somebody new comes into the building like that?
Well, it'll be a new experience for me too, since Jay was in the building when I started 8 years ago. I like and respect Kevin, and I trust he'll do a good job, and I'm looking forward to working with him. You have a lot of smart, opinionated people in the room, and so you'll want to work with those folks. I think there's also a lot of respect for the chair and what the chair does to take a lot of the visible noise that happens from markets and the press and others. And so I think I look forward to working with him. We'll see where we go.
He makes the case for a number of changes at the Fed, one of which would be a smaller balance sheet. Where do you come down on that?
Instinctively, I like the idea of the Fed having a smaller footprint in financial markets. I think subject to us still being able to operate monetary policy and control rates well, and subject to not having severe adverse reactions in the markets. But instinctively, it's an attractive idea to me if we can find a way to make it work in the context of the rest of what we're trying to do.
He's also said he'd like to have a little bit less conversation from Fed officials and maybe more coordinated interactions with the public. What do you think about that? Maybe asking you not to speak as much.
Well, that would give me some more time, so I'd be happy with that. No, what I try to do in my outreach is very, very district oriented. And so I was in Martinsburg, West Virginia yesterday. I was in D.C. The day before. I was in Harford County, Maryland last Thursday. I was in Northern Virginia on Tuesday. I was in Baltimore on Wednesday. And in each of those places, I'm actually not, talking to you. I'm talking to chambers of commerce and Rotary clubs and people who are interested in what's happening in the economy. And I think there's real value to being in front of these folks and putting a face on the Fed. The design of the Fed was a regional design from the start. And I think part of it was people wanted to trust and understand the people who are making these important decisions, and also to feel listened to. And I take a lot of pride in how much interaction and engagement I have across my 5 states and District of Columbia. And I hope to continue doing that. But to me, it's not, and you know this because we've talked a lot before, I'm not trying to talk about how many rate cuts I have in my SEP for the next 9 months. I'm trying to talk about, here's how I see the economy, and ask them, how are you seeing the economy? I think I get valuable insight that way.
One last question. Would you like to see Jay Powell stay on as a Fed governor after his term as chair is up?
I like Jay a ton. I think he's done a spectacular job, and I want Jay to do absolutely the best thing for Jay.